Hello, happy Friday, everyone. Welcome to our fifth seminar. So today we'll be talking about some common management letter findings and just some tips to help prepare for the audit to kind of, avoid those findings, or some good tips to lead you away from anything that might come up during the audit process. Just a couple of housekeeping items. If you or anyone attending via the web having any technical difficulties, please refer to this slide for some troubleshooting. And if you don't have the slides, you can go ahead and email us and we'll send those to you. We're also offering CPAs for this seminar. So throughout the presentation, we'll be saying three kind of keywords, and you'll have to submit those with the survey at the end of the presentation to get credit for the CPA. So I'll say those during the presentation as well as those attending online. Please make sure to jot those down. Great. And so we'll just spend a minute. I think there's a lot of familiar faces here, and so we won't go into too much detail about us and our firm. I think this is our fifth seminar now, so we've been doing these for several months, and our firm governor is very proven. We really specialize in the audit and tax for nonprofit organizations. So we thought we would bring that sort of management financial processes and best practices to the Baltimore market. Bob and I are both partners in the audit firm, or the audit department of our firm. So if you guys ever had any questions that come up throughout the year, I know Hannah reaches out to us with her questions. We're always available. We really have a passion for working in the nonprofit community, so we like to make ourselves available when possible. Okay. All right, we're going to jump right in. So we've kind of structured this presentation. We'll start with just general policies and best practices, and then we'll go through, we it out by the trial balance structure. We'll talk about the assets, some liability, equity, some other items, and then for those of you that receive federal money, we'll talk a little bit about the A-133 or the UG, the things that come up most often. So these are, the most common management letter comments that come out of an audit for a nonprofit organization. And so we really, by bringing these to you, you become aware of what, on the auditor side, what we're looking for when we're practicing our procedures and things that, when we see these come up, we would possibly write these down and communicate them to management and governance in that management letter that you all receive as part of the audit. So one of the first things that I think we see most often, and honestly, this has become much better over the years. So it's been a number of years since Sarbanes-Oxley came out and required certain policies to be put in place for the for-profit community, and that ultimately trickled down to the nonprofit community as a best practice. So when we talk about the Sarbanes-Oxley related policies, we're talking about making sure the organization has a proper whistleblower policy in place. Not only that, but when we're auditing an organization and we see that you have a whistleblower policy, it's more that the employees are aware that there's a whistleblower policy. That is there to protect them. If there were an instance where they felt there was misuse or fraud, they could report that without the repercussions or being cleared of repercussions in reporting that. So we oftentimes, will have our random interviews with employees throughout the organization and just ask the question, are you aware of a whistleblower policy? So I think having the policy is one thing, and communicating these important policies on an annual basis is also a best practice. And that really goes also with the conflict of interest, that you not only have the conflict of interest, but it's being revisited on an annual basis or a periodic basis. And this includes, you know, some organizations do it for all employees, depending on how large the organization is and whether that's feasible. But most certainly you would want the key employees and members of your board, because oftentimes there are related activities that are being, you know, performed or given by a board member. And so those things, those situations are fine, but you would want to document that and have that in case a conflict ever did arise, and you know there's an awareness and a transparency within the organization that there might be a potential conflict.
And just one second, there's no problem if you have a conflict. It's just that everybody needs to be aware of it, and that the services are going to be below market value or at or below market value. For those that actually are grant-making organizations, and you have people on your board who might be the CEO or a board member of another organization, they should probably not be involved in the awarding of the grants. So there are reasons why both board members and staff should sign these. And most importantly, what we've seen many times is that everybody signs them, and then they just get filed as personnel files, and nobody summarizes what the conflicts might be. So there could be 3 conflicts, but the people in finance have no idea, or the people making decisions don't know. So it's imperative that the conflict of interest form goes to probably the HR manager if you have one, and that the conflicts are summarized and then distributed to those people who are making decisions.
Yep. But as you said, like these policies, it was several years ago when we would walk into an organization and no one had these policies. But I think the industry has really come around and making sure that they have all the policies in place. And that also, you know, is attributable to when the new Form 990 came out and they asked, do you have a whistleblower policy? Do you have these things in place? And so then it became not only a best practice in the industry, but a best practice in the eyes of the IRS. Accounting Policies and Procedures Manual. So this is, you know, this document is an ever-evolving document for any organization. It's not something you put into place and then, good, we're done with our accounting manual. It is constantly revisited and improved upon, maybe even annually or maybe even taking a look throughout the year. So first and foremost, we want to have an accounting manual and a financial policies manual. And that really is, it's for several reasons. First, it provides a consistency in how we're treating types of transactions. You know, if there was ever a question or something that came up, we could look to our policies and procedures to say how we're supposed to handle this. Secondly, it becomes a great training tool, or in the instance that there is turnover in the organization, you know, it becomes a tool in that for the new person coming in, they can also look to that. So oftentimes we see that there is no accounting manual, and this is a comprehensive manual. And maybe we say, well, we have this policy, this policy, this policy, and like 20 different places. But really, you would want to put it into a formalized document that management and the board ultimately approve. And more so that the policies are reflective of what's happening in practice. So again, another instance that we see most commonly is that maybe the manual was set up several years ago, hasn't been looked at for a long time, And what's happening in practice isn't what our policy says. And so, again, we go back to this is an ever-evolving document that you need to update and look at periodically. But this is one of the most common management letter comments that we give. Because when we come in as the auditor, we are looking at your policies and auditing to your policies. So if your policy says you collect travel reimbursements 30 days after, us as auditors are going to look at that and say you are or not in compliance with your own policies. So it becomes a critical document in driving several aspects of your organization's practice.
I mean, nowadays, most organizations should have this word probably on their internet where all the employees can see it, and then it's edited annually. Where we see people fall down or organizations fall down, we keep computers. All the policies or procedures in there are documenting the old computer system, and things have changed drastically. So this is something that should be looked at annually. We know it takes time, and it's for a priority. But I can tell you that this does come up almost, I'd probably say 75% of the audits we do, policies are just not current.
Yep. Kind of piggybacking on that, in investment policy, if you do have an investment portfolio, you know, you really should establish a formal policy, and that should be done in conjunction with the board and the finance or audit committee or whoever dictates on how we will be investing the organization's funds. But this is an important policy because it outlines the amount of risk that a board is willing to take and what they would find the acceptable investments and who can really initiate transactions in and out of this investment portfolio that we have for the firm. So it should hit on a number of different things, but if you do have an investment portfolio and maybe it's not necessarily robust right now, but it could be in the future, or it could outline the board's strategic, you know, plan for investing for the organization.
I would say that this policy also should address if you have endowment funds, scholarship funds, and how the earnings are to be used. It should set aside that, you know, what the growth potential is. And the reason to have this policy is really so management staff aren't making the decisions. It's really, this is the board level decision. And it takes the guidance away from them.
Another just general common item that we see is proper segregation of duties. And really, you know, this is a double-edged sword because, you know, it certainly depends on the size of your organization and the capacity to hire, you know, staff within the finance department. So oftentimes, just due to the size, there isn't proper segregation of duties. And we certainly recognize that. We know that due to the size, we can't get there. But there are things that we can put in place, you know, outside reviews or, you know, two eyes on everything, although not within the finance department. There are certain key controls and processes that we can implement to help mitigate this item, but it's certainly something that for our smaller organizations we see quite often, and it's the nature of the size.
And the smaller organizations, those limited staff, a lot of the duties that will mitigate this fall to the executive director, and that means the executive director has to have some financial wherewithal, know-how, savvy, whatever you want to call it. They just have to understand the financial statements and the controls because they're going to be the ones looking at certain items, whether it's bank reconciliation, investment, et cetera, et cetera. They're going to be the second control.
Yeah. And then we had governance items on here, so making sure, you know, we have all our charters in place for the board, or outline descriptions on the committees and their responsibilities, making sure our bylaws and all of our formal documents are up to date. All right, let's hop over to assets and some common findings.
And before we go too far, I will say that the majority of our findings that come out of the audit process generally revolve around the asset and liability accounts and how we're doing there. You don't usually see that many comments that come out of our test work over revenue. I mean, we'll talk about that. Or the expense side, but that's mostly procedural. These are probably more substantive, and this is where you'll run into some, I don't want to say significant deficiencies as you go. This is where you'll find the tougher comments by your auditors if things aren't in place. Because as the audit process winds down, and we're trying to wrap it up, it's all about whether your assets are fairly stable. And so if some of these accounts aren't properly reconciled, there you're going to get the problem.
And that's what we'll see when we flip to kind of the help and tips to prepare for the audit. I mean, the biggest thing that you can do is just make sure every account, the schedule, the subsidiary schedule, reconciles to the trial balance. It is, I mean, I can't think of an audit that we haven't walked into, and some schedule that we're given doesn't reconcile to the trial balance that we're provided, and whether there were subsequent adjustments and whatever the case may be. But it's often that we find most of our comments within the balance sheet. And you know, throughout the year, you're taking care of the money coming in, the money going out, and there's a lot of focus on that. But at the end of the year, you know, that focus should flip to make sure that the assets and liabilities are properly reconciled. So cash. Okay. So well, first, cash we wanted to reconcile. Okay. So that's the first thing.
But here's the funny part on that. I mean, you know, we say we want the bank reconciliation to be done properly. We want it to reconcile to the ledger. Okay, that sounds great. Okay? But for those organizations, back to those that are smaller for a second. Okay, so the bank reconciliation, we would like somebody else to review and approve it, and that usually falls to the executive director in cases. Okay, does the executive director really know what outstanding items are? Do we present them good bank records, but do we to them the ledger so that they know that it's high? I mean, it's a teaching process, and we know that it's a question reconciling items that are unusual. I mean, there's a process here that goes through, but that in and of itself is a different comment, because sometimes we'll sit down and say, well, you signed off on this, but do you know why this item is reconciling? And so we do find that, but that's,
we do find that. But all too often we find that this action doesn't reconcile. And so that in and of itself is a pretty important first step. And really, you know, if there are adjustments to cash, that's going to be a big issue for your auditors, because cash is cash. You know, we know what that balance is. There are no underlying estimates. It is what it is. The reconciling items, we are looking at that. We are saying, okay, you have these deposits coming in. Did they really come in? You have these outstanding checks. Were they cleared subsequently? And more so, the checks that have cleared subsequently, are they properly recorded back? If you have checks, I have a client that on their outstanding checklist had a check from 7 years ago outstanding, and 7, 8, 9, 10, and like the list just went like 600 rows. And we're like, okay, you know, what's your policy on taking these outstanding items and moving them to a liability, and then working with the people to try to get them to clear these checks or reissuing these checks? So we're definitely taking a look at those reconciling items. What's old and outstanding? What needs to be cleaned up? So definitely something we focus on.
generally speaking, outstanding tax and reconciling items should all clear within 90 days. Those that haven't cleared within 90 days should have, again, back to policy. You should have a policy to investigate why these things haven't cleared. Like you could have an outstanding check on there. It's probably been voided and reissued, but nobody went back through and voided the check. And so there's that process. Many times that's what we find when people actually go back and start to investigate. So there really should be a policy of investigating, reconciling items outside of 90 days, and you could say 90 to 120, but when you start to get in that, you issue a check to a vendor, why haven't that? So there are strange things, but really keep it in mind. Focus on that comment.
Yeah.
And then, you know, sure, go ahead.
I understand what you're saying. I have employees that treat reimbursement like my savings.
So one comment was that she has employees that treat reimbursement check like a savings account and wait to cash it.
Yeah, I mean, I with them to get them to cash it, and you know that they haven't gone. So what do you do? Because on our part, we are aggressively trying to get them to cash it. I mean, I even reissued and had to track down the person because they haven't cashed the
Wow, that's
you know, they're employees,
Yeah.
and it's frustrating. I understand that, and you know, you just tell them that after 60 days we're going to void the check, or not 60 days, but after 6 months we void the check and we'll reissue it. You know, yeah, I know. And
oh my
there's not much you can do, and I appreciate that. That's a tough one.
Or should we just document that we have had?
As long as you know that the check is still good.
Yeah.
It's more times our concern, and we don't get concerned with $15 checks, $20 checks. More along the lines of we wrote a vendor a large check.
$50,000, and it's been outstanding for 6 months.
And
come on.
you know, I can't believe the vendor's not going to catch a $50,000 check. But so we focus on the larger checks, or in aggregate if there's a lot of checks. So I mean, small items, and if they're employees, we can just make a note. You know, discuss with the employee, ask them to cash.
Once the business knows as well, so we know how long they cash the check.
Right.
If they has to cash, we need to contact them and say, look, you must have lost the time.
Exactly.
And that does happen.
We actually get room. Have it clear. They check number, check this before. Yeah. You tell us whether you got it and attached it, or I haven't gotten it, you issue it, or I got it and I lost it, or it's not mine. So they have to respond. We don't just void it.
No, that's
good.
And, you know, that's impressive. And honestly, you're probably one of the only organizations where I've actually heard that.
Yeah.
It's impressive. And as we start talking about that, just most importantly, and it's who prepares the reconciliation and who approves it. You know, there should be signatures. And most importantly, I notice people sign great, most importantly, date every time you sign something, date, because when we come in and the reconciliation is prepared and it looks great, but we have no idea when it was prepared. And so we're looking to make sure things are done timely. So if there's no date, yes, it's a March 31st time. Got that. Okay, but it's probably not prepared on March 31st. So when is it done? Is it done April 10th? 8th? Where did we do it in June? If there's no date, we don't know. And so you'll get a comment. Now, it's not critical, but it points out that you can't tell if things are being done timely.
Just a clear audit trail.
Yeah, and it's an easy thing to do, and quite frankly, teach those that are in your organization that anytime you sign anything, you're doing on state what you're doing. You know, whether it's a grant agreement, a contract, a reconciliation, anytime you sign something, put the date next to it. We run that comes up a lot.
That's probably the review and approval. Typically it's but we do it. I'm like, I know, but there's no evidence of it. So we need now you to formalize the evidence that it is being done.
Is it common or is it something that would be brought up in the
I would, generally, we don't see them going to the
Yeah.
audit committee, or, I mean, that's,
That
That-
level of, yeah.
I would tell your audit committee and your finance committee that that's not their function.
Yeah.
Kind of like to say that, but that's really not what they're there for. They're there to set policies, not be involved in day-to-day management.
And higher level financial strategic planning for the organization, and that is not the level of detail that they need to accomplish that. You know, they should be getting financial statements on a periodic basis, quarterly, but the bank reconciliation, you know, it's a little. Oh. Right.
We're all different.
Yeah.
But I would say that's not a role. If I'm sitting on an audit committee, I don't want to be involved in it.
So if you stop doing it and you are on the
You can say a management response. We don't think the role of the audit committee is the day-to-day management function. So
You just have to get your committee to buy off.
yeah.
And while we're going to give comments at the end of the audit, and that's what we do, and many times the numbers are the numbers, and whether it's our audit firm or anybody else, the numbers should be the same. So it's the recommendations and comments that come from the process. And it should be looking forward, while some of it's looking back, and the battle for the comments, what we want the audit is going forward, and recommendations that are hopeful should go forward, not necessarily quick. I didn't do this, you didn't do this. You want constructive information that helps the organization with the controls. So we're kind of pointing out items that come up, but we really want items that help the organization. Yeah, just get your controls where they should be. So, you know, I mean, like I said, I think most importantly is when are the reconciliations done and reconciling items. You know, if they're not done timely, there's a risk of anything going wrong.
So you reconcile items. So within that account, it's not $500 million. There's something wrong here. We can't find it.
I don't know the size of the organization.
$20 million.
Okay. So $20 million, you probably have a lot of money in cash. You know, sometimes either write it off and go, or leave it as a reconciling item and it'll clear in October.
Well, that's what I'm hoping. But my question to you is, how picky do I need to get? How picky is my auditor and get and say, you know, you should let me
You know, there's a you know, here's the question. You know, here's the question from us: is it 10,000 one way, 10,509 the other? Okay. So if all your outstanding checks, you know, they're all current, they're all clear, you know what they are. It could be. And so I would let it go. There's a certain amount of time you have to spend on it, and a certain amount of time where you have to say, okay, we're done, let's move on. And then you look at October. Maybe October everything's fine. It goes away. If it doesn't go away, then you've got the system where that at some point needs to be adjusted.
That's why
There's a efficiency thing that comes into play here.
So investments really, it's the policy, making sure.
Yeah, we talked about this.
Yeah, we did.
Policy. And most everything we find here is policy. And I'll tell you what we do find that's interesting is that many times organizations, they open up an investment account, and they might have a line of credit against, and nobody really knows that happened. I mean, it's there, but it hasn't been used, and all of a sudden it's kind of like, well, wait a minute, we didn't, the board didn't authorize it, but when you set it up, there is an account where you can borrow against it, so that comes up occasionally. And that's, whether it's a liability account or an asset account, I mean, it all goes into the investments. So just be wary that sometimes investment brokers will open up the account and you'll have the ability to borrow against it, and that shouldn't happen unless the board is authorized that.
Loans receivable.
Loans receivable, I don't know, sometimes organizations are granting loans to people, not people, but other organizations for any number of reasons. And really what happens here, it's all about flexibility and follow-up. I mean, many times we give somebody a loan and we just don't follow up. Is it flexible? Is it not flexible?
Yeah.
It's really due diligence.
It is, just making sure that we're collecting. And sometimes what comes up is, they're interest-free loans for a large amount over a long time. Do we need to impute interest or take a look at that?
Or there's no formal agreement.
Yeah, or there's no formal
agreement. We run into that a lot. Oh, we gave them a loan.
Or it's a big international organization, their loan portfolio, what is the right allowance amount? What do we need to establish as an uncollectability rate that we've seen over the past 5-10 years?
Do we give employee loans?
Yeah.
And the question is, are they documented?
Again, back to policy.
Back to policy. If we give employee loans, how many can they have in one fiscal year? What's the term to pay it back?
Do they need to pay one back or taking out another?
And there are
things like that.
So there again, most of the comments we have, aside from the allowance side, fall under policy, and whether we're adhering to it, and whether the loans are actually
Advances, again, what is the policy?
Yeah, I mean, almost every group gets a comment. In the scope of the year, if I run 100 audits, I'm going to have this comment in 90 of them because advances are issued for travel. Our policy says submit the expense report within 10 days after you complete your travel. And I look at the list and it's like, I come in February, the end of the year is December, and we have outstanding travel advances from June. Yeah. And usually, and mind you, the bulk of this is usually senior management. And we know this, and I understand that, but I would also say that if you have a policy, make it realistic. Don't say within 3 days after completion. Make it 10 or 15 because people travel, they're trying to get things done.
That and they're issuing new advances, even though the old ones haven't been submitted and cleared out. I mean, it comes up all the time.
You don't typically say you don't do that, but you can get a more communicative. Is that outside of it?
That's outside.
It's a little bit outside it, but if you're a retirement plan audit, it would fall in there.
Yeah.
And again, I would assume the documentation on it is very good.
Well, nowadays with the 403Bs, especially almost all retirement plans, a lot of that is kept online. That is a direct, you're going online, you're requesting the loan, maybe you're getting a copy of the request, and the financial institution has already set up the amortization and the interest, and their payments are being deducted from payroll in the future. So, oftentimes the loans for those are they're set up nicely through whoever your custodian or trustee is. We don't run into issues with that very much. Advances, accounts receivable, I don't want to spend this.
We're going to try to save a little bit of time.
Yeah.
Accounts receivable is a little bit like advances. And the question is flexibility. Why do we have a receivable? And I was looking at a financial statement yesterday. And this is where sometimes I'm dealt with my staff. But I looked at it, and we have accounts receivable for a significant number. But when I look on the revenue side of the financial statement, we have the grants, contributions, and investment income. I'm like, well, what does accounts receivable go to?
Yeah.
Is it really accounts receivable?
Or
right. So,
receivable?
Is the reimbursement for expense? I don't know. And so, sometimes if you follow the revenue streams, it makes sense to really have accounts receivable. That's not generally a comment, but it raises a question.
Fixed assets, I think the only two things that ever come up on here, do you have a policy? What is your capitalization policy? Are you following it? Is your policy $5,000, and do I see a computer on your listing for $1,200? That's outside of your policy. And the other one would be just old, unused items from the 80s. Like, you really still have the fax machine from the 80s, you know, in your office, in use. Let's clean up our fixed assets and write those off if they're not in use anymore.
And part of going through that all the time is really beneficial for your insurance.
Your insurance,
I mean,
and the personal property.
Don't tell them that you have, you know, $1 million worth of fixed assets when 400,000 aren't in use. So it's kind of, let's keep this current. Again, the $20 million organization back there, I'd like to think your capitalization policy is not 1,000, 2,000, 3,000.
5,000.
Yeah.
There we go.
Right. You know, but we find organizations, I look at, at our firm, there's always a second partner review, and I look at some of the, and the policy is always supposed to be in your footnote. And I look at it and it says, capitalization policy is $500. I don't know who has $500 policy anymore. I mean, it's crazy. So,
It is crazy, though. Our lender is actually one of those when we bought something for $500.
yeah, that's a different issue. But, you know,
So we have to tax it so that if they should come back and say, you know,
that's fine. That's a different issue. But, you know, on the capitalization policy, it needs to be realistic with what your operations are. Right? You can't, I mean, at $500 nowadays, you can capitalize every share that you buy. But even nowadays, computers are generally looked at as supplies.
There's supplies. Computers, I mean,
what do you use for what?
what, on a computer?
Laptop?
Yeah, 3 is
Where
about,
I go.
3 is about right.
You know what?
But,
I
like,
think you're
but
lucky.
they're
I think
under-
you're lucky to get 3 years out of it.
So like the federal government, the new UG regulations, they indicate $5,000, you know, is considered, you know, a capital with 1 year, and they have specifically said tablets, computers are supplies. You are to categorize them as that. And so, you know, it was happening in the industry, and they ultimately formalized it in the new regulations.
But generally, most computer equipment, 3 years is the
Yeah,
standard
3 years.
for
Yeah.
computer.
No, but so we have been when you purchase and bulk like we bought 3 years.
Yeah.
We were the ones that had
Right.
that issue with the computer. But typically, we will purchase all at one time that we pay a high bill.
Right. No, it's a per unit
I think
value.
it's per
Yeah,
unit.
so our question was, what if we buy in bulk and it crosses that threshold? You know, when we're talking about the capitalization, we're talking about a per unit rental. So if your computer is over $5,000, then that's different. If you buy 10 computers and it's $25,000, or whatever the case may be, you know, we're going to capitalize the whole purchase order.
And maybe there's one other issue that goes with fixed assets, and that might be the procurement. But we'll get to that later, because really, procurement is not just fixed assets. It's all goods and services, and we'll talk about that later.
Okay, let's talk about just a few liabilities. Notes payable and lines of credit. Okay.
And what I normally see here, and this is, you know, we all have different lines, but what I normally see here is lines of credit or notes payable that have been opened without board approval.
Yeah.
And that's the big one. You know, we enter into a note agreement, and there's no board approval for that. For a line of credit, as I mentioned earlier, 600 see that. And all of a sudden, if we write that comment in the board, you automatically sees it, you know, like, what's going on?
Yeah. I think one of my biggest things here that I always see that people forget are the covenants that come with the debt when you open it. You know, even lines of credit nowadays have certain either reporting or other financial ratio covenants that you have to meet, or say you can't open another debt stream over X amount. So those are things that we're looking at and testing for to make sure you are in compliance with your covenants. And especially with the reporting, you know, they usually say submit your audited financials within 3 months of your fiscal year end, which is, you know, it's not reasonable, like whatever was written into the debt agreement, and therefore you're not meeting that reporting requirement. And we want to make sure we're either getting a waiver or we're working to formally amend our agreement to make the covenants more reasonable.
Quite frankly, whoever signs these that, entering into a note, beginning in the very beginning, covenant like that, somebody needs to be aware that we're not going to meet that in 6 days, but 6 months is more reasonable. So, again, reading the terms and conditions will get rid of these comments, but that's a big one. It is. Because we always look at covenants, and many times finance isn't aware, or somebody's not aware that we have to do certain things.
Accounts payable.
Accounts payable is not much. I think what happens here.
Outstanding items, like if we have things over 90 days, maybe it's not, why aren't these being paid? And oftentimes it's just they're not cleaned up. They were paid, or maybe they were incorrectly expensed again and not reversed to payable.
I mean, and the other one is you haven't properly
recorded.
I mean, if we're doing the audit in March for December year end, your accounts payable, everything that came in January and February should be on that list. And you ought to know. And if we come in and there's significant items that weren't reported, you can get a comment here. Again, it gets to controls, it gets to the reconciliation process. End of the year, more important than on a monthly basis or something.
Yeah, the cutoff.
Yeah, it's a cutoff. That's a cutoff.
Cutoff.
And we've run into that.
Cutoff.
Deferred revenue.
One more question.
I'm sorry.
Old invoices. I've actually, we even had a situation, I think something happened in their accounting department. I guess they weren't sure whether they had paid, so they resubmitted the invoice and changed the invoice date.
Oh, there we go.
Numbers.
So let me comment that, sometimes you receive this invoice floating through the mail months and months after the services are performed, and kind of, what happens when we get something. There's a point where there's a reasonable cutoff for your book that you're closing, and we're going to just have to expense it.
If it's significant, you should know about it anyway. Whether you have an invoice or not, if there was significant services provided, you should know an estimate of fine. If it's not, $1,000, $2,000 would be fine. If they were that late in invoicing you, the time paying them.
Yeah.
How do you get there?
We had one situation where we actually proved the expense, and they actually submitted the invoice to the county, and they paid our bill. And I didn't know that. We were like, wait a minute, and we kept calling.
But they can pay.
Yeah, well, they said you were happy.
Yeah.
It's funny. Sometimes it doesn't necessarily call on us, but like I said, we were aware that we should have been called.
Yeah.
But they were having some type of problem with their accounting department. The person that managed the one person left.
Yeah.
And we all know that there is turnover in the accounts payable, accounts receivable positions in every organization. And so it happens on the vendor side, it happens on our side, and timing. And as I said, most importantly, end of the year, make sure we just caught everything. That's what you do.
I love that question.
Okay.
So the question was, did we discuss if in federal awards, when we're purchasing equipment over that capitalization policy, what our organization's capitalization policy is, what happens then? And gosh, Bob and I, we have
Tell you what,
different opinions.
we just had the Inspector General's office from one agency in our office.
Yeah.
They want it capitalized.
They want it
They want
capitalized.
everything capitalized in the future.
Okay.
Now, here's the issue I have.
You can't expense it and reimburse. get reimbursed
Well,
for what you, the outlay's already out.
I think you can. I think they'll let you.
I think so too.
That's fine, but here's my issue. If you depreciate, let's say you buy whatever it may be, it costs $10,000, and you're going to depreciate it for 5 years, right? Here's my issue. My issue is, what if it's only 2 years now? And so therefore, now, so I take my position as expensive to the reward. That's my position. Okay, now, I know that the IP is giving my other a hard time.
Yeah.
They haven't got to my client.
Well,
but I usually
we received guidance differently over 2 years that
Yeah.
go between two of you, and we don't know what the real right answer is.
you know what? I don't think the industry knows, or you're in the same boat as everyone else.
you know, they're trying to pin it on GAAP
Right.
and
Yeah.
say GAAP says this. Right, that's what they're saying. And yet, I'm looking at it going, I can't match my revenue and expenses.
Yeah.
You know, especially if this asset's only, and we're back to title. Who really owns this?
Yeah.
You know, you don't necessarily own it until it's the end and they give it to you. They could take it back. So I like my clients to accept.
I'll say that is what the majority of the industry
So
does.
let me ask you a follow-up question to that, because I actually like that position. But the asset has a value, and it conceivably you would want to show it on some depreciation statement for useful life purposes.
You have to.
But I'm saying that I'm getting this signal.
You have
Even from you guys.
You have
what
to.
the right answer is.
If you expense it, which, you know, maybe we agree is okay, maybe we don't. And generally speaking, a lot of my clients have a policy where if it's purchased with restricted funds, and it doesn't just have to be the U.S. government, it could be another donor that gave them a program to purchase something. Generally,
That's easier to handle.
yeah, but it's still, but you know, the grant can only be 1 year, and it, you know, you can buy something significant.
It's a federal award.
Right. But so even so, you have a requirement where you have to maintain a good list, and it's under property management in the uniform guidance. So you have to keep a list of what you purchased, serial number, location, cost, acquisition price, et cetera, et cetera. And as long as you have that, I think you're fine. You're within the standard.
So nothing on depreciation at all.
Well, just
finish the question to make sure I'm clear. So the good list does not have to be a depreciation.
doesn't have to be, but just beware that there are Inspector General's offices out there that are pushing the opposite and asking that it be capitalized. And in fact, uniform guidance actually wants you to be in conformance with GAAP, but my problem is, you know, if you purchase something and it's got a useful life longer than the grant, you know, 1 year you're going to be overstated, the next year it's going to be understated, and we're missing the
collectability, invoicing of funds,
That's,
you know.
that's really the issue.
Yeah.
All of our personal.
Exactly.
We have that experience.
Exactly.
Thank you. I kind of thank you.
Yeah, I know. Us too.
But what you did was you gave me an idea, because this question is, do we put it on the depreciation schedule if it's entered for use of life purposes, not recording the depreciation purposes, just tracking the asset. And
Definitely tracking the asset is critical.
Yeah.
Is there a distinction between the gap and grant reimbursement? So the way we've handled that is we have a contract. So the asset, the full $10,000 goes up and then on my balance sheet, that contract count that.
Right. I've seen that done.
Include that contract. It doesn't include that contract count. So it looks like I spent all my money.
Right. Basically, what you've done is you've fully appreciated it in the same year you purchased it, because you've got the contract there, right? I mean, you're offsetting the capital.
But isn't it all? Is there a difference between the grant reporting for reimbursement versus the gap?
Well, this gets into, there would be if it was capitalized and placed on your books as an asset and then being depreciated. And then,
Because the expenses
and I'll
are
tell you
there
what,
and you're only.
this is going to get a whole lot more complicated, because when you go to do your indirect rate, you know, are we taking out the asset, then we're going to take out the depreciation. I don't think the IG, I'm going to speak out of line here, but just bear with me. But I don't think they understand, the ramifications all the way through. Whether it's revenue recognition in one year versus another year, whether it's the impact on the indirect rate, et cetera, and how much time is going to be spent taking items out and placing them back in for indirect rates.
The proper account that can be a layer of management, and so what we got to do with Audit is not create a layer of management, it's really a product of it. But here's the real test. This is the first time we've had something at this purchase level that we'll have to report it about $75,000.
Yeah. So
and so the question is, how we're going to look at it.
Right.
But thank you.
All right. Let's wrap up with our liabilities. So I do want to give the first CPE words of the three. Audit. Audit. My favorite. Yeah, you watch it. I'm gonna skip. Let's go to equity. Unrestricted net assets. So we have our three categories for now. You know, that'll change in 2 years. We'll have 2 categories. But first and foremost, net assets, one of the biggest things that we see that generates a comment is that your beginning balance net assets do not reconcile to the ending balance of last year's audited financials. Because they either don't post audit adjustments or they're posting directly to net assets throughout the year for temp restricted activity. So one of the first things we always check is, do your beginning balance net assets and your trial balance agree to last year's audited financials? Okay, generates a comment all the time.
Yeah, and really, again, back to accounting policy. Don't post anything to record an equity account. We all know that, but it happens. Now, it may be the way your computer system is set up. You want to post things directly to temp restricted during the year because you don't want to show me the gross amount that was received. I understand that. But maybe before the auditors can change that back to the way it should be. Just, you know, you got to get that, you got to reconcile to last year's ending for the audit. The only other thing I would say here is, it's not for everybody, designated versus undesignated, right? And just yesterday, I was looking for something. So, board in its infinite wisdom or management in its infinite wisdom has decided to designate $1 million to set aside for the reserve. But our total,
they don't have $1 million.
But their unrestricted net assets are only $800,000.
I was looking at one yesterday, same thing.
So
they
here you go.
designate more than what they
You
have.
can't designate more than what you have. Plain and simple. Otherwise, designate $1 million with $10 million.
So here's where that happens, though, is that you take the $500,000 or the $1 million and put it in an investment account. And each year you say, okay, our board designated is the balance in that investment account at the end of the year. So the investments go up and down. It's, it doesn't change, you know, $1 million, $1.2 million. And your operations over the past several years, you incur losses. And then all of a sudden, the $1 million is more than what you have in unrestricted in the first place.
Yeah. So what you've got is the auditor saying, you got to get the money designated.
Undesignated.
You can't designate $1 million and have undesignated as $1 million. Doesn't make sense.
Or you could be designated non-citizen.
No,
it could be
board
however the board designated.
Yeah.
It could be for lots of different purposes, but at some point, you can't designate more than you have.
Yeah.
And this comes up a lot, and generally speaking, what we do is we may have a comment, but we may not put it in writing until we've issued our draft and had a discussion with the audit committee saying, look, you know, this has to change before we issue our final report.
And so we have an opportunity to, you know, make that adjustment and undesignate funds to cover the operating deficit.
And then the permanently restricted here is really just, does the organization know what they used to be investment income? And I realize many of these things now go back so long.
Yeah.
But, you know, at some point, you know, the finance people in the room here should have a real good owner's intent was for how it was to be used. And the investment earnings to be used for operations, where it's supposed to be used for scholarships. The comment that we normally have is, do we even know what the intent is? That's what we know.
Yeah.
Okay, so here's my recommendation to you on your $20 million. Here's a $13,000 endowment. I might write it to the donor.
You try. Please undesignate those. Yeah. So it'll be there forever. Yeah. In perpetuity. That's what they need. Let's skip over revenue. So grants and contributions.
It's the classification, really. Here's what
Unrestricted.
Unrestricted, temp restricted, firm restricted. It's the classification, and then I'm going to get to somebody else's comment for you today. How often? And I love walking the development department over here, the finance department over here. Finance has $20 million in revenue. What does development have? Oh, development has $30 million.
So this is a very comment that we look to your members, and this will be, you know, the outside database that you have, and do the two departments reconcile, which goes exactly with members. You know, it's the same thing. Are we tracking these things in Personify or Razor's Edge or whatever? And they say, you know, this is what we have, and then finance over here. Well, are we ever reconciling these two databases?
And I realize, it's a long time. Development wants to record things as soon as they hear it, they put stuff in, you know, but at some point, at the end of a quarter, 6 months, annually, that finance and development should sit down with those and reconcile. And so this is a good number. Because many times development has things, they've got commitments, and finance doesn't know. It's unusual that finance has recorded something that development doesn't know. But this comment actually comes up quite often in larger organizations. It's not the small ones where the ones with small budgets because everybody's talking to each other. It's normally the larger organizations where development's off on the second floor, finance is on the third floor, and nobody's really talking to each other at the end of the year. There was a draft audit issued, and all of a sudden the president said, "You raised more money than that." So, you know, this comment comes up.
It does.
And it should. And it's the same with the membership dues.
It's the same.
You know, the membership dues, you know, again, you have a membership department.
Database, membership database, department, person, you know, it doesn't reconcile to what our finances is.
And then the question is, membership dues are generally voluntary. Mm-hmm. So, you know,
are we recording a receivable
if
for
they're past
them?
due and we record a receivable, is it really collectible? If they're voluntary,
yeah.
Did they pay? Are they? More importantly, from an organization side, are we still providing services to a member that, or a former member that hasn't paid? And I think those are questions that might get asked. They may not be raised to the level of open comment, but they'll be for discussion.
Seminar and workshop fees?
Seminar and workshop fees are interesting for anybody that works overseas and conducts workshops and maybe, you know, pays or has or trainings and it's being funded with U.S. government money or other donor money. You know, we have a list of people who attended. Sometimes we pay these people per diem for attending, and we don't have any documentation that people actually attended. I would just say, if you're doing that, it's all about getting names of the people who were there to support the per diem that were issued. I mean, because that could rise to a point where the auditors might question the cost because we don't really know if these people attended or didn't. Yep. So it's some publication.
All right. Let's touch on salaries. Yeah. So
we could spend a whole day.
We could spend a whole day on this. So we're going to try to limit it. So salaries And, you know, I think we mentioned it again in a couple of slides on our compliance findings for the federal awards, allocation of salary expenses. So this is something that, especially with the compliance in your federal awards, it comes up all the time, and it's an issue. So first and foremost, timesheets. And, you know, we're going to talk about timesheets in the context that we do think everyone should have timesheets. Now, the new regulations came out and said, you know, if you have a better way of coming up with actual after-the-fact determination of how time was spent on these programs, you don't necessarily need timesheets. They also said as long as if you budget throughout the year, as long as you can get to the actual number periodically and adjust for it, you can also do that. But why?
Honestly, the only way you can get back there
is timesheets.
Here's the thing with timesheets. There's a lot of comments that you can go into all day long. Bottom line, it should be filled out by project, by program, by function, whatever way you want to do it. And then they should be signed, dated, once again, dated by the employee and the supervisor. That's just, yeah. I mean, and we have more comments about that. We have more comments about the way it's filled out.
The way it's filled out. If I see a timesheet with 10 cost centers and the same percentage every single timesheet for 24 pay periods,
she's going to get upset with that. I'm going to say, well, I got a timesheet.
Well, it becomes questionable. Are these the actual hours worked? Are we budgeting? Are we putting in? Are we just resubmitting? Or the timesheet where I can see that the dates have been whited out for different periods over and over and over.
And I actually just got back from doing some testing with a client on timesheets, and interestingly enough, every employee had a template on their computer in Excel, and it already had the total hours
filled in, pre-calculated.
It had the total hours filled in, and had the percentages filled in, but it didn't have the hours. So each employee had to figure out the hours by day. And I'm like, if they can do that, they can do it.
Anyway.
But, you know, so I mean, there's a lot of ways, and at the end of the day, maybe the percentages are right anyway. Now, I have other groups that don't get federal money, but they have a lot of restricted funds. We still would probably say best practice, not for time to consist. For instance, salaries might be 50% of the total budget. Add benefits may be higher. If we don't know how that 50% is being spent, or which program it's going to, how do you even prepare a budget when you do the proposal for the next grant? I mean, we've got to get there at some point. We need to know how we're spending our time. And I realize, you know, we're not lawyers, we're not accountants, we have to do our time right. But we need this information to build proper budgets for the next proposal. You know, it just makes sense. It's good management.
In the sense that we have it in the function also. And we give them 3 or 4 holes. And their timesheet is an allocation. We say, okay, so this, the 4 awards, 100 kids altogether. This award is 130, this is 120. So then we say, okay, so take your day and split it.
20, 30, 50. Got
Right,
it.
right.
That's acceptable.
You know what? I probably can't argue with it, and I'm not going to argue with it because there's a, well, and it's also based upon how, you know, what they're given in 26 years. You know, so probably 50% of the time is going to that one. Now, if the grants are structured differently, and 50% of the time really doesn't go to that one because that's the easy one, then you have to just have a discussion. I'm going to be lenient on how the hours are recorded because you know your programs better than we do. But at the same point, when we see the same time sheet every pay period, the same amount of hours every day, it gets a little strange. I had one where there was a typo and 100 employees with a typo in their formula. And so every employee works 16 hours on the 9th of the month. Every month. I'm like, really? Everybody works 16 hours on the 9th of every month? No. I'm like, okay, so these are just pre-printed and everybody's just signing on it. So, I understand there's a lot of ways to do these the right way and a lot of ways to do them the wrong way. And when they're done the wrong way, we have enough experience that we're going to see that.
The client that we went to, and they were working, an hour and 45 minutes. And in the formula, they were putting 1.45 as the time spent. So that was it. So, you think you can't find another way that you can, kind of mess it up, but you'd be shocked.
And to be honest, you all are working in the nonprofit community, not billing your time. I mean, you are charging your time for grants, but you're not billing your time on an hourly basis. Don't make it more complicated. Don't do 1.1 or 1.2. Do it in round hours. If you're working 8-hour days, working hour days. If you really want to have everybody report all their actual time, that's fine. But it's going to drive finance crazy because at the end of the month, the denominator is going to change, and then your percentages change. And, unless you're investing in a nice time-keeping system where you do this easily, it's a headache. And we understand that also. We really do. Personnel files.
Yeah, just making sure that they have updated salary information, if there's any changes throughout the year, bonuses, things like that. There's a record of any action when it comes to salaries and related benefits.
We look at personnel files. I tell my staff we're only interested in documentation work that we do. Many people nowadays are going to electronic, and raising the document electronically. That's fine, but you have to have a method for showing us that it's distributed properly and that it's documented somewhere. Personally, I think that none of people can print that everybody's personnel file. Personnel files will probably at some point become electronic. So now you're going to deal with the safeguarding documents. I think loan documented personal files. Other than that, that I'm not interested in whether we do the annual review on a timely basis. I think that's an HR function, and I'll leave that to HR. I'm just not interested in looking at that. I'm more interested in looking to make sure that the salary expenses being paid is proper. And one of the other things on the salary, this is the last comment on it, it could be changed. The salary within one year. Who calls the payroll company and says, you know what, this person got a raise. Let's give them a raise. Everything you do in finance, who puts the new employees in and who authorizes the raises within the payroll? If one person has too much authority, he's to say, I can't just put another employee on there and give him my address. And so be careful with that. We look at that. Rental expense nowadays, and this is going to be interesting because the standards are changing in a couple of years. Where the whole lease agreement is going to go on your statement of financial position. But right now, what we see is if you have a lease agreement that's up to date, are we paying what we should be paying? It's mostly that information. It's surprised. You would think that this would be easy, but it comes up. And we might have deferred rent that we haven't had.
People, allowance for improvements, the build out, making sure that everything is amortized properly. Not too much.
Not too much about it. Occasionally.
Yeah. Travel expenses and credit cards. Yep.
Yeah.
Yeah.
I'll tell you what. I'm not a big fan of discounting to pay the future payments, and I just don't think. If I discount the credit side, because those are your payments, I have to do the debit side because your asset is going to be
doesn't make sense.
I don't see the point
Yeah.
of that. I would put the full lease commitment on, and then the full lease commitment on as an asset also. We start getting into future value discounts, then every year we're changing the value of that right of use asset, and I'm not necessarily in agreement with that. And there's no impact on the income statement. We're changing the asset in my vote. And there's a little bit of money in that.
Travel expenses and credit cards. This is a comment that, again, comes up so often around, especially the credit cards, like missing receipts, travel expenses, missing receipts outside of your policy. Your policy is we collect everything over $50 or $75, and you have those few people. You always say if you have 10 people, 5 or 6 are good. Then we have 2 that are spectacular, and then there's those 2 that just never turn in the receipts. Yeah.
And
no matter what you do.
Even if there's 2, then somehow 2 of the others never get to like that. But and we hate writing the comment, but we have to write the comment. But the problem is, it just doesn't go away because every year there's non-compliance issues here. We talked about it under the advances a little bit.
Yeah.
This gets back to policy and how often things are submitted, whether this is timely, whether it's documented properly, whether the business purposes documented. I mean, many times there are receipts and somebody went to Bed Bath & Beyond. And, is that a business receipt?
Yeah.
I mean, it was at the end of the day. It was.
For the office.
Yeah. But and then credit cards. I mean, and here's an interesting question for you here. We all have the expense reports, and hopefully the board is reviewing the CEOs and the executive directors' expense reports. How often do they have a company credit card? Are they looking at these charges on the company's credit card? That gets missed sometimes. But sometimes that company's credit card statement should also be funneled to whichever employees. Yeah, because there's a lot of expenses on there that probably aren't going through an expense report because the company's paying direct. So who's really looking at that?
Normalization, I actually sign off on that time sheet and also
I see fine, no issue. But the board hires the executive. You work for the executive director. If the executive director says, no, it's a good charge, word on it. And if they ought to be reviewed by the board level.
This is why we have policy in place. For example, you go out to lunch, get somebody out to dinner, pay the J. But we say, don't just give us the slip that you sign. We want the itemized receipt because any alcohol on it. Yeah. And so we're very clear about that. And you won't pay your credit card until all your charges on. And then if you go and charge it, your credit card late, you won't be able to charge.
I understand. That's a fine policy. I'm okay with that. The only other I have about credit cards, so many organizations I go to. There's 100 employees. There's 100 employees, and 60 of them have credit cards.
Yeah.
And I'm like,
why?
What are we doing? And they're like, oh, they're young. They just started. They couldn't get a credit card. Well, why do we give them one? I mean, what are we thinking here? So, generally speaking, and you'd be surprised how often this comes up. I mean, it's funny. I mean, people who travel a lot, I understand. Senior management, I understand. I would also say, I think the appropriate policy is that when people are out at dinner, the most senior person. I mean, that's practice also. You don't tell the young guy who's looking to get credit or miles to, you cover this. So there's a whole host of things that come up with this.
I just want to put something outside of you. I will tell you that we do that, and especially about the local news, we have one quarterly basis.
No.
And what I was going to say was look at it as a ability and sensitivity on the part of our people. What they did before was they were a little casual sometimes about the behavior because unless they were
approve
on
the
a quarterly
payment.
basis, on a
It's not.
semi-annual basis, it's making sure that there's accountability. And many times, and you know, I've been doing this a long time. I've seen babysitting charges on there. I've seen massages. I've seen all sorts of things that really are not business related. Now, if the CEO charges it and the board says it's fine, then what are we supposed to do? As auditors, you know, we may say, you know, it's not really right, but the board at least reviewed it, and it protects both the board and the employee. And at the end of the day, the executive director is.
All right, let's skip over sub-awards. We'll save that for the compliance slide. There's just a couple other items that we jotted down. Software, as auditors, we are taking a look at your IT structure, your IT controls. Nowadays, you know, we rely a lot on systems or third-party processors and making sure that they have the right controls in place to properly process the funds for your organization. So with that, you know, we often review those controls or ask for those third-party processors to give us, you know, their audited statements or their SAT 70 or SSA 16 report on their controls, and we're looking to make sure that they don't have any glaring issues. And if so, that the organization has put in a mitigating control so that nothing comes up. I'm sorry, say that again. Mirror in what respect? So if you're relying on them to process, let's say, payments on your behalf, you know, you want to make sure that if they're handling your money, that they have good controls in place to adequately process those payments. Or
if you hire a third party to do any type of verifying function, you really want to just ensure that they have the proper.
And we just did that in our government about payroll vendors.
Yep.
Our health benefits vendors, they handle our PR stuff. Banks.
And they're generally fine with due diligence on your part is just to check.
The auditor also said, I'm supposed to rebuild, put policies and procedures in place so that we're doing what they're doing. Well,
I don't.
I'm telling them
they're doing that.
It's your job is to read the report and understand if they have any weaknesses, and if there are weaknesses, what mitigating controls are already put in place to counteract whatever is brought up in their reports. Generally, the reports are.
And they said that, like our payroll. So the payroll company said, yeah, we back up everything 5 times. So they back up. Then they said, well, what if they shut down? What if they go out of business?
You got a bigger problem.
Yeah.
So they said, why can't you get a copy of the database? Well, that would be silly. What?
I've not.
Yeah,
and
I've
then,
not.
you know, there's a reasonable.
We fall back on that.
Yeah.
Yeah, there's a reasonable.
I want to say the second word is prepare. We're going to run through these really quickly so we stay on time. Recurring operating losses. We take a look at your income statement, and we've seen that operations have lost money year over year over year, and your net asset balance is just dwindling. You know, this is something important to bring to the board and the committee to say, hey, red flags, you know, we've used a lot of our reserve over this 5-year span. What are we doing now to ensure our viability going forward? What strategic plans do we have? You know, tell me what you're doing to change this trend that we've seen over the past 5 years.
Yeah, and it's normally not just 1 year.
One
Year
year,
the board may, or even the board may say, you know what, we've got a plan, we're going to do new initiatives, etc. This is if things have slid the wrong way and your unrestricted net assets are now falling at negative, and we have plans to raise more money. It's also a discussion before anything goes in writing, but and we just kind of think about it.
Yeah. Adequate supporting documentation, I mean, that's pretty straightforward, that you have support for the transaction. And then functional expenses and consistent allocation. again, we did spend a whole seminar on this. You know, I won't go into too much detail, but making sure, yeah, go ahead.
No, I'll tell you that we spend a lot of time looking for consistency. And that's really what we're talking about here.
Yeah.
You know, we did have that seminar.
Yeah.
It's mostly about consistency and who the allocations make sense.
Yeah. Okay, so let's just touch on some of the single audit compliance findings. So the new UG standards, allocation of salary expenses. You know, we talked a little bit about that before the UG standards came out. There was a lot of buzz in the industry that, oh, we can get rid of timesheets, we won't need timesheets, and come to find, you know, you ultimately need to get in a setting place, and the best way to do that is timesheets. So,
I mean, you know, it's really interesting.
It really
Even
is.
though they modify everything, you still got to use it.
Yeah.
There's no other way to get the budget to action.
I mean, it's just, it's
It's as simple as
not
that.
reasonable. Procurement.
One of my favorites. We skipped over it, but you know, for goods and services, every organization should have a separate procurement policy. It should be great. You can either have a separate policy, or you could have it within your county policy procedures. Procurement most often is, and this gets back to conflict of interest. If we have a threshold, let's say 15,000, 20,000, whatever the number is, where we need to get competitive bids. You know, how many is reasonable? 3, 4. I mean, we should have a minimum number that we should get. We can get more, but we need a minimum number of bids to get. And then, what fails many times, we select a good vendor. Why? I might say, come in and say, well, you got the bids, that's nice, here are the bids, great. Why'd you select vendor A?
Yeah.
It's not documented.
Okay. So first off, just making sure you have a policy in place. Secondly, that we're following the policy, and Bob said that there is, you know, that when I ask for the procurement for this vendor, I'm not going to get a printout of one, a forward email of another, and a discussion with another person on their discussion with something. That we have, you know, a one-page summary of here's our 1, 2, 3 bids, here's what they were, here's what we were looking for, and a conclusion as to why we selected who we did. You know, it's all too often we go in and it's being done. Like there is a whole vetting process that they're going through, but there is no organized formal policy or way to capture what the organization, what steps the organization was taking to get end result of who they were selecting.
Whoever is making the decision, which should be documented, we selected vendor A because it doesn't have to be lowest price. They may be just the best bet or supplier or consultant. However, whoever's making that decision should not be the person who's going out and getting the bid. I mean, we need to keep some independence here because too often you see there's relationships, there's money that goes back and forth. You know, it's crazy that it happens. And I could tell you stories that you wouldn't believe, including one where they thought there was fraud between the finance person and one of the procurement and the vendors. But how do you prove that? They actually went in and got the cell phone log and looked and saw there were phone calls between 11 o'clock at night and 5 o'clock in the morning. This is not business calls. And so they finally said, you know what, even if it was personal, that the appearance is just bad. So, you know, so I would say who's ever making the decision of somebody goes and gets the bids, then the decision process now comes up to Jen. She's making that decision process without me without documents. So you have to be aware of that. Many times organizations also do this a lot good. They don't often do it for certain. And really it should be for you hire consultants, if you hire somebody like that. I know there's a lot of groups that do training and have specific trainings that they do over and over. I would say at the beginning of the fiscal year, the beginning of every other fiscal year, kind of get their quote as to what they're going to be charging. And this might be our preference list 1 through 20. And you know, if you can't get training 1, we'll be doing 2 and 3. stay away from the word sole source.
Okay.
I think
So
it's just non-competitive.
You use payers as an example,
Yes.
which is an example very relevant to us. And so, there are certain topics of the desk that we have left on, and some of us, we already know the really good ones.
We know the really good ones. But when was the last time we checked their price against anybody else who might be not as good, but good? And maybe at least you've done something, and at least you've categorized.
Or we're teaching the same class, but 4 different teachers are teaching.
Right. I think you just have to go through the process once every, in your case, I'd probably say once every other year, just to get a pricing and say, this person is still our number one, and you have to have
Sole source is not an option. You can
No,
choose to do. And I think that's what the industry was doing, is we choose this person because we've worked with them for a really long time. We know they're good. Sole source is in the instance where you're going out to bid and there are no other suppliers. So making sure that if you're using the term sole source or documenting sole source, it truly is no one else can provide this. Now, if someone else can provide this, we're doing something else. That in our policies we say it's our policy to have a 3-year contract, and at the end of 3 years we will evaluate every year for performance during that 3-year period. But every 3 years we are going to go through the formal RFP process again. So just making sure that comes up all the time. Yeah.
Yeah, and we see that all.
Yeah, we do.
And yeah, that's getting me into one.
All right, so subrecipient monitoring with the new regulations, I think the first and foremost, the most important thing here is documenting the relationship. All too often we see that we're calling them a subcontractor in this agreement that we have in place, or subcontractor, when in essence the nature of the relationship might be a subrecipient. And so really determining, okay, what is this person doing for us? Is it, something that they do in the normal course of business for many organizations, their contracting or purchasing, their services that they provide, and that's it? Or are they a subrecipient where there's a two-way conversation about, what decisions we'll be making programmatically together, and how they're going to implement the work on the ground that they're doing. So, whatever you may call them, it's first important to document the nature of the relationship. That then determines whether they are a contractor relationship that we have entered into through procurement, or that they're subrecipients that now we need to monitor, how they're spending the funds that we're passing through down to them.
I will tell you that this is one great thing within the mentality. But it becomes very easy to monitor. We all have fun, because what's going to happen is it says we have to assess risk, we have to monitor, we have to evaluate, we have to assess risk, evaluate, then monitor. And so if I say you have 10 sub-recipients, let me see your risk assessment period one. Well, we looked at them before. Are they high risk, low risk, medium risk? And if they're high risk, what type of monitoring procedures do you have? If they're low risk, what are we doing? And maybe if they're low risk, all we're doing is getting their audit report at the end of the year. If they're high risk, maybe we're more involved. But you have to have this now, and right between the guidelines.
So the guidelines actually say you must do a risk assessment, which then dictates what monitoring procedures you will do, such as, and they list training, getting your A133 report, site visits. And so what used to be a best practice is now a formal regulatory requirement.
Read that part, please be a part 200, and your new policy should kind of mirror that.
Yeah.
And because it's going to be very easy for us to walk in and say,
We're
So the right say that are physical monitoring of the certificate. There's a mandate on site.
No, it doesn't
There's
need
nothing,
to be
it's
on.
your policy.
Yeah.
It's your policy. I'll tell you what, I spent too much time talking to the IT people, right? And they were hung up on this. They're really hung up on the sub-recipients because there's many sub-recipients that aren't being audited as they should be, and they want all the questions, all the questions
Of what you slowed down.
But, and I had a long conversation with them because they asked me to come down and talk to them, and I said, not everybody has the same fiscal year. So one of your sub-recipients may not need to be audited within the same period because it's on their fiscal year. And so it's interesting. So they kind of backed off on that, but I will tell you, if your sub-recipient has a December year and it's now past September 30th of the following year, when their report should have been audited and issued by, and they haven't done that, we know that really all your questions should be questioned because it's a question that they haven't done what they're supposed to do, and you're responsible for what they're doing. The IT is kind of taking a hard line on this. So just be aware of that. That's all. But the sub-award monitoring is going to be a lot of findings coming forward. It's going to be good.
That's the thing. Large government. And I didn't really know. And so I got one who does my federal taxes doesn't show up on the sheet. Okay, so I go back to them and I said, well, the auditor said we're the third, we're like the third stuff down, and we don't have to report it, and it's a little bit of money, and so I send an email to whoever's in charge, and I never get a response. So I've done my part.
Yeah.
You've done your part.
Yeah. And I can't make them change the financial.
No, I understand. You've done your part. We as auditors, if you, here's what I'm looking for from you. You tell me you've done everything you can. The next question is, why are they sub-recipients? Why did you think this?
Yeah.
I mean, that's a good discussion, but a valid one.
All right.
If they're not compliant.
So in the interest of time, suspension and debarment checks, I mean, it's been several years now. Everyone is going on the sam.gov website, running the name through of the vendor, make sure they're not barred by the U.S. government, and we're not doing this.
It's kind of certification.
Yeah, they do. You still have a little bit of responsibility.
Yep. And preparation of the schedule of expenditures of federal awards. This comes up quite often as a finding that we can't prepare our own CPA, or we don't know how, or like putting all the correct information that's required on there. So what we tell an organization when we come in and they're struggling with that is that look through your last year's audit report. It's very easy to pull that and then update for current year information, but making sure we have all the award agreements and the CFPA numbers. We know it's actually federal money. We have all our federal money that's on there, not just taking last year's and updating, but we have any new federal money that's being captured. The expenditures, is based on expenses, not revenue. We have the time period. So there's a lot that goes into that schedule, and just making sure that it's accurately prepared, because ultimately, us as auditors, that is what we're auditing. And, if that's incorrect, it can change our entire scope of work. And so, I mean, it's been so many times where, we come in, we get a multi-million-dollar schedule of FIFA, and all of a sudden they give us a new one, which completely changes our whole audit plan. And so, that costs time and money on everyone's part. So really understanding the schedule and how to prepare it is very important.
From
Yep. Oh, the pass-through award number. Yeah, maybe not. Yeah, it's in the regulations. The regulations literally list 1, 2, 3, 4, 5, 6 items. I can send that to you after the fact.
Because
No problem.
what we found is we were referring to the way, and apparently it wasn't referring, and we didn't look at the right section.
Okay. Yeah, no, let me provide that to you. Yeah.
The other thing is, last year's audit, last year's schedule is really old. It's unusual that the organization, if you're funded by health and human services, right? It's unusual that the next year you're going to be funded by Department of State or Department of Labor. I mean, it could change, but that's unusual. And while the expenditures may not be exact, they're probably, you should be able to get close to us with that.
So I would use the organization, and I was willing to die by that house. I do believe it. And basically the audit is very simplified for the whole schedule as a listing state. And that's not taking
Yeah, no. They did change under uniform guidance. There were things that now you need to do, like subrecipient expenses. That was not required on the face of the CPA prior to uniform guidance. It is now a requirement on the face of this. It can't be in the footnote. Or there's now a specific pass-through identification number. So any of your pass-through funding has to have this unique number presented on the face of the CPA. So there were changes. But for audit purposes and planning purposes, we're going off the expense and the CFCA numbers and your clusters of programs. So as Bob would say, year over year, that's relatively consistent that in planning we can predict what's going to become the major program, what is going to be covered.
And I don't want you to get, if you know in January that your expenditures under the CFCA program A, the 900,000, and it turns out it's either 875 or 975, that's fine.
Yeah.
You're close enough for planning purposes. The fact is that if you have left that one off, and all of a sudden that becomes a material amount, and it affects the test work that we have to do. Mm-hmm. And while I understand it happens, especially with people who are doing the organization, et cetera, it's time and it's money. Yeah. And as much as it can be avoided, try to avoid it. I know it doesn't. And we understand that.
Yep. Great. So we have about 20 minutes left. We're just going to go through 10 quick tips for the audit process and the audit process and how to prepare for it, and ultimately these would help in avoiding any findings. But one of the biggest things that auditors want to do is come in and, maybe we haven't seen you in a year, or we haven't had a phone conversation during the year. And, for us, we're pretty consistently in touch with our clients throughout the year, just, touching base, making sure that they don't have any questions. But ultimately, when we come in, we're going to want to discuss the changes year over year. Very high level, we're going to sit down with you, we're going to look at last year's numbers versus this year's numbers, and do a very high level analytics saying, okay, what's really the driver in these changes? Well, we invested more in investments because we had a big reserve or profit last year, or, our security deposits got a new lease space, so that's why deposits went up. And so, we're also taking a look at your budget to actual. Well, we budgeted for, a $500,000 gain, and we have a $500,000 loss. What happened? Why are we so different than what we predicted from last year? So, just be prepared at a very high level, and most of the time it's very easy to sit down with the CFO or the controller because they know they're in the details year long. But just make sure that any of those changes are going to be discussed. Governance, management, ownership, you know, any significant changes in board structure, the key personnel, new entities that might have been formed, programs, operations, so any significant new streams of revenue or programs that we're running, technology if we change the accounting system or other significant databases, and then our industry funding sources. You know, maybe you haven't had federal awards before, but now you do, and we come out to audit, and all of a sudden we realize you need a compliance audit because no one told us that we now have federal money. So just making sure, you know, throughout the year that we're discussing these things come audit time. It's not a big job.
As Jim just mentioned, we come to sit down in your office before the audit is due, and you give us the end of your financial statement, and we look at it and say, what happened here? Salary is down $500,000, or they're up $500,000. What happened? There shouldn't be a question that I ask on those financial statements that you can't answer. And it's not going to be, I'm not looking at accounts payable changing by $10,000 or $15,000. We're looking at the big overall trend, and I would like to think that everybody can answer any of these questions. You know, if salaries are down $1 million from the prior year, something happened.
Maybe a layoff or something happened.
Something, yeah. I mean, you know, if they go up, you know, and maybe $500,000, we can only make 3 or 4%. And you say, well, you know, we've got a couple new positions, and we gave everybody a raise, you know, this week. Fine. But if they went down, they went the other way, you know, I mean, there are trends that we look at, and, you know, you shouldn't be caught off guard by any of those questions. That's how the trend starts.
Yep. Use the PVC list. So everyone has received these standard PVC lists, any audit firms, so provided by clients. It is a great guide to just go down and, you know, we try to be as all-inclusive as we possibly can. And maybe, you know, there's too much on that list, but it's great to go through and just say, yes, I have these things. We give you that list as a tool to help you prepare for the audit, and just making sure that we're devoting time, that, you know, we have people that know who's preparing what. There's a proper review of those schedules, and that they're realistic time expectations. You know, we're not going to look at the BBC list the week before the auditor is supposed to be on site. If there's something that should be done well in advance, and even as you're going throughout the year, you know, these schedules, your fixed asset schedules can be easily, you know, maintained and kept up to date throughout the year. So come audit time, there's not a significant administrative burden that we need to go back through these various activities and reconcile those. And request clarification. You know, this is one thing, we're there to answer questions. If you're not sure what we're asking for or something seems unusual, we're happy to explain exactly why we need the information that's on there, or, you know, just give you a better understanding of what we're looking for. Oh, did I go through the same thing? Oh, these are ready. Same thing. All right. Prior year.
Yeah, we can skip over that.
Yeah.
But, you know, generally a good guide is you've got your assets, you've got your liabilities. There should be reconciled, and there should be a supporting schedule. A supporting schedule is not general education.
Correct.
I mean, I have clients who do this general education. I give it right back. Come on, I can see this. Years worth of transactions in here. Tell me who owes what.
If you give me a prepaid GL that has debits and credits in it, no. Give me the prepaid, the vendor, the balance of the prepaid, what the year policy was, and what we have left to amortize on it. You know, that's it. There's no GL detail.
Yeah, we as auditors may not look at every single account, but you're on the other side. You're internal, so you should make sure that all of your internal accounts are reconciled properly. Sometimes I may say, you know, I know this number is not material to it, but I want to know what's in this account. Or, for instance, you paid a expense didn't change from 1 year to the next. Why not? I found it hard to believe it's the same number.
It might be the material.
It might be the material, but what it is for me, somebody's not doing what they should be doing on a monthly or So there are, again, we'll get through an audit very quickly. All the accounts are reconciled.
Yep.
And that's really what's happening.
Yeah, I mean, that in and of itself, you will be good to go. Let's do our third and final word for the CPE. It's finding. We've already talked about 6.5, again, beginning balance and assets, reconciled to last year's report. We need a good starting point to even start the audit. So if that's going to change, then there's your first audit adjustment. Bob already mentioned tip 6. Know what's included in those balances, not just the GL detail. We want just what is as of that fiscal year end date, and that's it. And we started talking about this earlier in the accounts payable. One of the most common things we find is, let's say you're a December year end, we're pulling checks from January through when we're out in field work, so after your fiscal year end. And what we're looking at is that you paid invoices that have come in after the fact, but are for expenses that relate back to the other year. And so now I have a $50,000 consulting payment in January that for work that was performed in December, and I go and I see you don't have that accrued or on your AP schedule, and there's an audit adjustment. Do your own search for unreported liabilities. Pull those subsequent payments and make sure that anything that is being paid for expenses related to your fiscal year is properly accrued for.
Even if it's not accrued, if you just bring it to our attention and say, can you please make this adjustment?
Yes, it will consider it the adjustment you gave us and not an audit adjustment.
Right. It's no longer an audit. It's really just, you close your books.
I just saw this come in. We need to,
Yeah. Just be mindful.
So if you're an organization that receives grants, make sure you have the grant agreement, especially with the federal funders, or just that you have the full agreement, because maybe you get the one NIH front page, like with the boxes and you have all the general information, and it says see attached appendix 1 through, and we don't know where all of the appendixes are, or where the full award is that really tells us what you're supposed to comply with for that grant agreement. Then we're emailing the funder during the audit, can you please send me a copy of the award, and we find something that...
And believe it or not, we actually do.
Yeah, we actually do.
But we really, and I had a client many years ago, and they made a habit out of every time we signed a new award, they just sent it to me. And interestingly enough, sometimes I glance at it, sometimes when I have free time, I'll just read it, and sometimes we summarize what the key points are. And in this one, they signed $1 million award, but their cost share for their matching was $70. And I wrote back to them, I said, do you understand what you just signed?
Yeah.
And they said, no, we're okay. But again, could have caught somebody off guard, and you hate to wait until the end of the audit to even find out that that's there. If you only sign 5 agreements a year and they're significant, or 3, something like that, it's not a bad thing to send it to your audit ahead of time.
The challenge that we've had in the last is funder business ideas. The award is made up of our money, and it's got stimulus money, it's got state money, it's got regular.
And they don't tell you what portion.
But then when they come and monitor me, they say, well, how did you spend this part of it? Well, you tell me that. You want me to report that.
That's very common, and
and now it becomes my problem.
Yeah.
Right. And the question is, does anybody in your organization know that those 3 component pieces? When we submitted the proposal to the Navy.
Sometimes they don't tell you that until, first of all, we don't get the award until 45 to 60 days into the thing. So we're already filled.
So you're already
already
at risk.
And then you get the notice of grant award, and now you're coming out. Oh,
You know,
And
that doesn't happen.
all I can tell you is there are always going to be exceptions to every rule. There really are. And all I can tell you is be upfront with your auditor. Better we know than we come to you and say, better you just let us know. Many times comments go away when you just tell us ahead of time. Yeah, just say, hey, we've had a problem over here, look over here. We know you're on top of it at that point. Big difference.
What you said about the difference between 25 CFR and the 2 CFR 200. To me, they're so the same.
They are. They're very, very similar with the other two. One is a specific.
So all the agencies have
I
a
know,
part
but
within the CFR that's specific
There's
to their organization.
There's
Or their,
several agencies have their own specific thing.
Like USAID is
They're
700.
So there are, but they're not, they shouldn't be long and drawn out because everybody should be focusing on 200. But then each agency has their own little section.
Yeah, because the funder is referencing 45 CFR.
Right.
And so we were on the 2 CFR.
You are, except that if that agency has their own little section.
They will refer to that.
And it shouldn't be all encompassing. So I don't know what's in 45, but it should only be in 240. It shouldn't be long.
Yeah, but that's very specific
Right. Okay.
to
So
agencies.
sorry.
Yeah.
Right. So that's going to be. I mean, there'll be different compliance issues within
Because it's complex.
goes in tandem.
Yes. So in addition to.
In addition.
Yes.
Yeah.
Yes.
Yeah.
Correct. Tip number 9. Prepare a roll forward of your temporarily restricted net assets. This is often one of the bigger items on the balance sheet that we look at and we spend some time with. Not only making sure, the new revenues are right, but that we're releasing it out correctly. So really, the schedule should be very easy. It says your beginning balance, net assets, what you had carried over from last year, that ties to your audited financials from last year, your new revenues, your new restricted awards, so whether they're programmatically restricted or they're restricted for time. So we receive $100,000 for 5 years, and we won't collect that until over the next 5 years. That is time restricted. Or the donor says you can use this for operations in 2018, time restricted. Okay, so we have our new revenue, and that revenue should tie to revenue accounts in your general ledger. Okay, so I should be able to take your revenue that you're saying is restricted on your schedule and go to your general ledger, your trial balance, and add up one account or multiple accounts to get the total revenue number. Okay, we're keeping our restricted and our unrestricted revenue separately within the financial. With the new. So that changes with the new standards. So the unrestricted the endowments that are underwater, now that changes. That before we had the transfer from operations to temp restricted to cover any losses, and then in the subsequent year that would be transferred back. That all goes away with the new FASB and stuff.
Stop fucking it up.
And so on that temp restricted schedule, then we're looking at the releases, making sure that, if we met it because of passage of time, that it's being released out, or that we spent the money on a program. And so I'm pulling a program income statement. I'm saying, okay, this is what we spent. We can release that amount. One thing we see often is that you can't have negative temp restricted, okay? So if you overspend on a restricted program, you know, we can only release up to the amount that we have. The rest is being covered by general operating funds. So, you know, making sure that our temp restricted is, they're all positives or zero at the end of the year to get to our ending balance. Our endowment income is being run through there if it's restricted for some purpose. And then also our discount on those long-term receivables or pledges, that is also being run through the temp restricted with the related revenue. And then our final tip, one thing that doesn't happen often, but just go through your last year financial statements. Take a look at the footnote disclosures that are in there. Do we have schedules prepared, you know, for the auditors that will allow us to pull this information together? It's all too often that we find a footnote that we didn't even discuss during the audit, and now, you know, after the fact, we're asking you for additional information.
You know what I would do is, if I'm doing what you're saying, I might say, at the beginning of the audit, why don't you send me all the footnotes from last year?
Update it.
Yeah. And many times what we find is, starting with the very first footnote, description of the organization.
Yeah.
You know, programmatically, maybe we've changed what we're doing, or we've added new programs. And when was the last time anybody really looked at that? But each footnote, you know, 1 through 10, you know, and these are your notes. I mean, we may write them, we may edit them, but they're yours. And so I would say, ask the auditors for last year's footnotes in Word, Excel, if there's tables, and you all go through and just dump the information in. And it just makes the whole audit process that much easier.
It really does.
Then back to us when we finish our field work, and you're that farther, you're one step ahead of the game. Doesn't happen often, even though we try.
And then I think, you know, what we've been saying throughout all our webinars, really, or seminars, is, you know, we're not just here for once a year to come in and you know, be the audit firm that offers a commodity. We're really here as a resource to you throughout the year. You know, you'd be surprised at how much we are able to advise you on in still maintaining our independence. So we want to hear from you. We want to hear about the things that pop up throughout the year. And come audit time, it's going to make the process go that much smoother because they're notified.
You know, we're a reference. Even, you know, many of you are not clients, and that's fine. But feel free. I mean, questions, and we have a lot of experience working in nonprofit communities. There are always things that come up during the course of the year, and we're always accessible via email or phone. Email easier, but you know, provide the trail also as to what to say.
Yeah.
I don't, you know, but even though many of you may not be clients, I don't want to get into massage that out.
Yeah.
You know, but you know, but I'm more than willing to provide guidance on any number of issues. If you want to go back to the audit firm and say, you know, you've got to do a lot of this work and fix it.
Great. We have one seminar left in our series for this year, which will be January 6th, and it'll be an open forum. You know, we'll bring a couple of topics up just in case no one shows up and no one has any questions, or we'll just sit here and talk all day, you know, so, but yeah, please feel free to sign up, register online.
Yeah, and if you fill out the evaluation today, the one thing I'm going to ask you is if there are topics you'd like to discuss in the future, please write that out. I mean, you know, please feel free to even send an email to our firm saying, you know, if you're thinking about future topics, you know, this would be something great to talk about.
Yeah.
We welcome that. We're more than willing to talk about any of the issues you all have. If three of you say the same thing, we'll design, you know, a topic around that.
Yeah.
So thank you all very much.
Yeah, great. Thank you.
Have a wonderful Thanksgiving holiday.
I know. All bands, everything. Yeah. All the holidays coming up.
As long as the weather stays nice.
Yeah. Yeah, really.